The fifth volume of the Yahoo Finance chart book is here, and essentially what this project is I ask strategists across Wall Street and economists across Wall Street a simple question: what is the most important chart for investors right now? And we can sort of form a consensus of what people are thinking about, what the risks are out there, and what the top things are that for this chart book have been driving the stock market rally. If we go back to January, a lot of contributors had told us that they weren't necessarily expecting tariffs to be what derailed this rally, right? And that is what did derail this rally. And so this version of the book really kind of takes a closer look at, okay, S&P 500 is back at record highs. How did we get here? And what could sort of propel us further. So I brought three charts with us today that I want to highlight that sort of hit on a couple of the key themes from this book. Our first one here is from Mike Wilson over at Morgan Stanley. And what Mike is taking a look at here is S&P 500 earnings revisions breadth. So companies that are raising their earnings guidance, revising it higher versus companies that are revising it lower. Look at what has happened since April, Josh. And if I were to put a chart of the S&P 500, it wouldn't be quite as dramatic, but it would be very similar, right? We've seen a V-shaped recovery in stocks. Then when you take a look at earnings revisions and you also see a V-shaped recovery, a strategist like Wilson will look at a chart like this and say, well, this tells me there has been a fundamental backing to this rally that we've seen in stocks. I think there's been some discussion recently among different members of the media and some strategists that we speak with, why have stocks rallied this much? The S&P 500 is up about 30% since April. What drove this rally? Well, it turns out tariffs, at least for now, are not impacting the corporate profit picture as much as people feared, and that's normally something that would drive people to buy stocks, right?
So that's Mr. Wilson's take on earnings. More broadly, Josh, when you were checking in with strategists, what do they have to say about the rally generally? Where do they seem to stand?
There's definitely a valuation debate right now, right? And sort of the question being, okay, the S&P 500, if we looked at just forward 12-month earnings, is above its 5 and 10-year average, right? Of course, again, the S&P 500 is near 6,400. Can it really go higher? Are we really talking about another year of a 20% rally in stocks? Well, look at this chart from Deutsche Bank's Binky Chadha. I found this very interesting, Josh. So what we're looking at in light green here is equity positioning, essentially where investors are in the market, how much their money is in equities. What you'll notice is that's neutral, right? That's essentially coming in at a flat zero. We're looking at our y-axis over here with where equity positioning is. Chadha points out, as you can see, your dark green line is earnings. Typically, equity positioning would be following earnings higher. You can see how it's chugging higher here, sort of chasing as those earnings estimates go up. Well, look at what we're looking at for the back half of the year, Josh. More earnings growth, right? And so with consensus expecting more earnings growth, Chadha is essentially arguing investors are not nearly as in this market as people think. Goldman Sachs' Ben Snyder also pointed out a similar point. They use their sentiment indicator. Their sentiment indicator's at 0 right now. That would be a neutral reading. And they say they think people can essentially get more bullish. So again, rather than talking about meme stocks and talking about these things that can maybe show us where it feels like vibes are at, when you actually look at where the money is, strategists would argue there's perhaps more room to run because more people can join this rally and come into the rally.
So you talk to strategists. You also talk to economists.
Yes.
What do they have to tell you?
Two key points from economists that I found interesting, Josh. So for one, tariffs were a part of the discussion, but not necessarily a leading driver of the discussion. The key takeaway I found, so we had four different economists send us charts on the labor market and specifically charts on immigration. So what we're looking at here in purple is the foreign-born population of the workforce, which I, of course, just made green by drawing over it. And then you take a look at this light green line. This is native-born, and this is your total. What's been happening as these different immigration restrictions have come in from the government, foreign-born is going significantly down. This would be a risk for areas of the labor market that have a lot of foreign-born employees, perhaps construction workers, other areas in the market like that. But overall, just a risk for the market that there will be less workers, right? So does that drive wages back up because there's less workers and there's more competition? Does it impact your unemployment rate? Is it an overall market risk? Mark Zandi from Moody's, who gave us this chart, said this is one of the key things he's watching when he thinks about second half growth and whether or not the US economy will continue to outperform. How much does this impact it? Are we sort of at a top at this point after we've had this big rally? Are stocks too expensive? So this is a chart from Barry Bannister. What he's looking at here is, as it says there, the enterprise valuation relative to economic profit. Essentially, how much am I paying for stocks based on what the companies are actually producing in some ways? And you can see here, it has not been this overvalued as Bannister estimates it since 2000, 1999, what is that? Of course, the dot-com bubble, right? And so that is kind of the classic comparison I think we're seeing right now is the question when you think about this AI-led rally is, okay, is it a dot-com bubble style thing? And at least by this metric, you could at least argue from a valuation perspective, it's looking a little similar.
I mean, Barry is a noted bear on the market. I mean, there are those who would say markets don't just roll over because of valuation. Something has to happen, right?
Well, and I think you see that here too, right? Look at where we call it overvalued in early 2000. That's a 3-year period that we sat there, right? And so you could also point out, yes, we've started to creep higher here, but to your point, Julie, the question would be what actually makes this matter? And you need some sort of catalyst, whether that would be economic slowing, some impact from the tariffs, et cetera. I also thought this chart from Max Grinikoff at UBS was interesting. So you're looking at the discount rate proxy versus the S&P 500 forward price to earnings ratio. This would be kind of a traditional valuation metric, right? And back to Barry's chart, if you looked at the S&P 500 forward PE, it would kind of look similar too. We're definitely in elevated levels here, but what this gap is sort of telling us that Max explained in his commentary is essentially investors are paying a lot for AI exceptionalism. And the question is, does that sort of come through? There is a world where this gap is worth paying more for if I'm an investor, right? And stocks being more expensive. But there is also a world, as we keep talking about during earnings season, where that doesn't come true, right? And then you're perhaps overpaying for stocks at that level.
Okay, and what's the third one?
Our final chart, I love this chart from Todd Stone over at Strategas. So what he's looking at here is the S&P 500 and essentially making the argument that it's less defensive than it used to be.
Well, and what I love about this chart too is it's the inverse of what we tend to talk about, which is that, oh, the S&P 500 is so heavily weighted to tech. Okay, so if it's so heavily weighted to tech, what is it less weighted to?
And it's less weighted to consumer staples, energy, healthcare, and utilities. So you can see that used to be 40% of the index going back about 30 years ago. Now, from a market cap weighting perspective, it's about 22%. And what I think this also tells us in this valuation discussion, normally you would pay a higher valuation for tech stocks or a tech-heavy index, right? Well, the S&P 500 is a tech-heavy index now. So Savita Subramanian in our chart book sort of made that point, that maybe it's worth paying up more and having it be quote-unquote more expensive if you're getting a different product or a different index than you were getting 30
Well,
years ago.
and you could also make the argument that defensive isn't what it used to be, right? It doesn't, you know, there were some who would argue that even tech has defensive characteristics and things like healthcare are perhaps less defensive than they used to be in the past. So these things are all kind of scrambled over time, it feels like.
They are. There's a lot of debate, always is. Makes a market.
That's what makes it fun. That's what makes our jobs fun. Meta and Microsoft set to report earnings after the closing bell. Will those results spark more demand for growth stocks, or is big tech's rally set to stall? Joining us for a look is our markets correspondent, Josh Schaefer, with another slice of the chart book.
Hey, Julie, yes, I want to focus in on one of our big tech charts from our chart book, which of course spanned a lot of topics, including markets and the economy, but big tech was obviously a key part of what folks were talking about. This chart comes from Vinu Krishna over at Barclays. And what Vinu is pointing out here, we're looking at in yellow, it is near-term earnings growth. Green would be multiple expansion, so that would be stocks rising, not necessarily with their earnings growth. And purple is your price return, sort of the spread in between those two things. The key one to focus on here as we're talking about big tech is, of course, the only square that we have on here where next 12-month earnings growth has actually risen more than the price year to date. And so what that tells someone like Krishna is, yes, earnings growth has been strong for big tech. Also, perhaps it means that big tech would have more room to run if they continue to beat consensus. One thing Krishna has followed for several quarters now, of course, is analysts often do not have earnings estimates that come in below or that are lower than what companies report. That has specifically been true for big tech. These companies have been consistent beaters, meaning that this yellow line would probably continue to rise on our chart here over the next 12 months. And if earnings continue to accelerate in big tech, as we saw this last quarter, where people thought the growth rate was slowing, it wasn't actually slowing as much as people thought. That spawned a rally in some of these big tech stocks. Krishna argues that that will likely happen again this quarter. Of course, we're going to find out pretty early tonight, Julie, with whether or not that trend is still in place.
Yes, we're going to get more clues for sure. Thanks, Josh. Appreciate it.